Welcome back to Smart Stock Sam, and today we are going all in on a stock that Wall Street cannot stop talking about. We are breaking down Ondas Incorporated, ticker ONDS, digging into the latest earnings and laying out the exact price targets you need to know about, including why a short squeeze could be right around the corner. Before we dive in, here is the quick roadmap for today. We have got a revenue explosion that will make your jaw drop, a $1.55 billion war chest that changes the entire risk picture, unanimous buy ratings from major Wall Street firms, and a technical setup that looks like a coiled spring ready to launch. Stay until the end, because we are giving you the exact entry zones, stop levels, and targets to build your own trade plan. Let's go. Here is the question I want you to sit with for the next few minutes. What would it take for you to believe that a stock trading under $11 could be one of the most undervalued defense plays in the entire market right now? Because the answer might already be staring at us in the data. Ondas Incorporated just reported a 629% explosion in year-over-year revenue, 629%. While most investors are chasing overstretched tech giants at 50 times earnings, this company, trading at just $10.90, has quietly built a $1.55 billion liquidity position. And Wall Street analysts are now projecting a 75% upside from here. But here is the catch. Despite those jaw-dropping top-line numbers, the company also reported a $101 million net loss. Now, if that sent you running for the exit, I need you to pause, because that loss is one of the most misunderstood accounting quirks in the entire market today, and understanding it completely changes how you see this stock. A year ago, Ondas was a fragmented technology developer working on isolated, disconnected solutions. Today, through a series of aggressive acquisitions throughout 2025, it has transformed into something much more powerful, a fully integrated system of systems defense platform. They are no longer just making components. They are building the connective tissue for international infrastructure and military contracts, positioning themselves right at the heart of the autonomous defense revolution. And that pivot, that fundamental metamorphosis, is exactly what is fueling those triple-digit growth numbers. Now, if the growth is this explosive, why does the bottom line look so ugly? This is what I call the GAAP Illusion, and once you see it, you cannot unsee it. On one side, you have surging momentum, $30.1 million in Q4 revenue alone, and a minimum guidance of $375 million for 2026. That is an extraordinary trajectory. But on the other side, the report shows that $101 million net loss. Here is the real story hiding inside that number. $82.2 million of that loss was a non-cash warrant charge. It is an accounting adjustment tied to the fair value of financial instruments on the balance sheet. It has zero impact, zero, on day-to-day operational cash flow. Operationally, the actual loss is dramatically smaller. The smart money knows this. They are not reading the headline number. They are reading what the business is actually generating, and the top-line acceleration is where their attention is. And when we talk about money, we have to talk about scale. Ondas is currently sitting on a $1.55 billion liquidity engine, anchored by a massive $1 billion capital raise back in January. This is their fuel for growth. It means they can execute an aggressive acquisition strategy without constantly looking over their shoulder at the next paycheck. Now, as disciplined investors, we also have to be honest about the trade-off here. That capital did not come for free. Every new share issued creates dilution, meaning each existing share owns a slightly smaller slice of the pie. Right now, the market is in a classic tug-of-war, balancing the long-term revenue potential of that cash against the near-term pressure of a higher share count. Understanding that tension is essential. So what exactly are they doing with all that capital? They are building a walled garden of defense technology. They acquired Rotron for drone propulsion systems and INDO Earth Moving, which came with a $140 million military contract attached. They picked up ONBERG Aerosystems for missile defense capabilities. And there is a pending merger with Mistral that would unlock direct access as a United States prime contractor. Think about what this ecosystem means. By owning the propulsion, the ground assets, and the air defense layer, every new acquisition makes the pieces they already own more valuable. That is not a collection of random bets. That is a deliberate, compounding defense architecture. But the hardware is only half the picture. The real X factor here sits in the strategic partnerships. Ondas has integrated Palantir's AIP platform across their autonomous systems. And this is not just a name drop for a press release. It genuinely unlocks AI-enabled intelligence and surveillance capabilities at a level that most sub-$10 stocks simply cannot access. Layer on top of that their ONBERG joint venture with Heidelberg, designed to build a European manufacturing base for critical infrastructure in Germany and Ukraine. And you are looking at a company that is deeply embedded in the global defense supply chain. Could there be a better moment for a company positioned exactly like this? You tell me. And here is something that should get your attention if nothing else has. The institutional money is moving in fast. Institutional ownership has surged by over 51% in just the last quarter. We are talking about Vanguard, BlackRock, and Hood River Capital Management taking significant positions. There are now 269 total institutional owners holding nearly 38% of the company. When you see this level of accumulation while a stock is consolidating, not after it has already run, it strongly suggests that the big players are building a floor before the next major move. The whales do not typically build floors in stocks they are planning to abandon. And Wall Street's analyst community, unanimously bullish. We have a strong buy and outperform consensus across the board. Stifel has a price target of $18. Lake Street is at $19. The average analyst target sits at $18.38. From the current price of $10.90, that is an implied upside of 68 to 75%. You rarely see this kind of tight clustering around high price targets unless the fundamental shift in the underlying business is simply undeniable. Now let us look at the chart because the price action is telling its own story. After a historic rally of over 800%, ONDS is not falling apart, it is coiling. The stock is holding firmly above its 50-day and 200-day moving averages, forming a symmetrical triangle, a pattern that looks exactly like a spring being compressed. A recent single-session gain of 8.35% confirms the bulls have not walked away. This coiling phase typically precedes a high-velocity directional break. The question is not if, it is when. The underlying momentum indicators are backing that picture. The relative strength index sits at 60, which is neutral to slightly bullish, meaning the stock is not overbought and has genuine runway left before it becomes extended. The MACD is also above its signal line, confirming that positive momentum is intact. But here is the warning that needs to be said clearly. This stock carries 183% annualized volatility. This is a high beta instrument. It moves fast in both directions. If you trade this, disciplined risk management is not optional. It is survival. And that speed could be amplified dramatically by what is hiding in the short interest data. ONDS currently has a massive 34.24% of its float sold short. That is over 157 million shares betting against the stock. The days to cover ratio sits at 2.01, the classic setup for a short squeeze. With major earnings commentary coming on March 25th, if that event delivers even slightly better news than the bears expect, those short sellers will have no choice but to cover, potentially triggering a spike of 10% or more in a matter of hours. The options market is already pricing this in, with heavy call volume stacking up at the $10, $11, and $12 strikes. But we never talk about upside without talking about risk, and there are real risks here. First, structural dilution. That $1 billion raise is powerful fuel, but more shares mean each share represents a smaller ownership stake. Second, a 3.36 million share overhang from former Bird Aerosystems shareholders who now have the ability to sell. Daily volume limits provide some cushion, but selling pressure is real. Third, Expect GAAP volatility to continue. Those warrants are still on the books, and net income numbers will keep swinging wildly on a quarterly basis. Anyone who cannot stomach that headline noise should factor it into their position sizing. So, what are the 3 things I am watching most closely to know whether this story is actually executing? First, backlog expansion. They have $68.3 million in backlog today. That number must grow substantially to justify the $375 million revenue guidance. Second, margin trajectory. Management has committed to product-level profitability by Q3 of 2026. If that timeline slips, the bull case softens. Third, the March 25th conference call. Listen carefully for granular detail on how those acquisitions are being integrated, not just that they were completed, but how they are actually functioning as a unified platform. That call will be the spark. Here is the trade setup as I see it. The tactical entry zone is between $9.95 and $10.25. That is strong consolidation support. A strict stop loss at $9.35 protects capital if the triangle breaks down. On the upside, the first short-term target is $12, followed by major resistance at $13.74. If we clear that level cleanly, the path toward the Analyst median target of $18.38 opens up with a lot less friction. Before I give you the final verdict, I want to be very clear. Nothing in this video is financial advice. I am not a licensed financial advisor, and this content is purely for educational and informational purposes. All investing involves risk, including the potential loss of principal. Do your own research, consult a qualified professional before making any investment decisions, and never invest money you cannot afford to lose. Past performance and price targets are never a guarantee of future results. With that said, here is the bottom line on Ondas. This is a classic asymmetric opportunity. On the bear side, dilution and accounting noise. On the bull side, $375 million in revenue guidance, a $1.55 billion war chest, unanimous Wall Street buy ratings, and a 34% short interest pressure cooker that is one positive catalyst away from igniting. If you believe in the long-term modernization of global defense infrastructure, the fundamental floor here looks solid. The March 25th catalyst could be the moment this stock finally steps out of the $10 range for good. This is Smart Stock Sam. Position wisely, manage your risk, and I will see you in the next one.